Hello everyone. In this video, we are going to use a simple example to see how change in exchange rate affects realized domestic currency return on foreign investment. So suppose that you're an American investor and you invested $100,000 in a British stock, and when you purchased, the stock price was £50 per share and the exchange rate was 0.5 pounds per dollar. So as you can see here, we are looking at the foreign currency price of US dollar. So this would be considered indirect quote, or this would be also called European term when it comes to exchange rate quotes. Just wanted to point that out. So let's say a year goes by and you sold your shares for £65 each. So as you can see, stock price went up, but the exchange rate also moved too. Now 0.58 pounds is the equivalent to $1. So if you just go ahead and sell your shares for £65 and convert your proceeds into dollars at the spot rate at that time, what is your dollar rate of return? And in this case, you obviously have no hedging. You're simply converting your pound proceeds from your sale into dollars at the spot rate at the time, so there's no hedging. But what if you had anticipated that you would be selling your stocks in 1 year's time, and you had agreed to sell £50,000 forward at the forward exchange rate of 0.55 pounds per dollar, and you did this at the outset of this investment? Then in that case, what is your dollar rate of return? So what we are looking at here is case of hedging or case of partial hedging, because we do not know exactly what the amount of proceeds is going to be in pounds in 1 year's time when you sell your stocks, because we do not know at the outset what stock price will be in 1 year's time. So you essentially just pick this amount of £50,000 as your best guess. That's why it's partial hedging. So now let's do step-by-step calculations. We will start by quickly summarizing your initial investment. So what was your initial investment in dollars? Well, that's straightforward, $100,000 that is given to you in the problem. Then what was your initial investment in local currency, which happens to be pounds in our case? Then we would simply take our $100,000 investment amount, and we would be converting it into pounds at the spot exchange rate that we had at the outset, and that will give us £50,000. Then how many shares did you buy? Since each share was worth £50 at the beginning, this means that we bought 1,000 shares. So this is just a summary of our initial investment, our beginning point. So we bought 1,000 shares of this British stock. So now, what will be your return in dollar terms with and without hedging? So let's look at the case without hedging. So this is when you do nothing, you simply sell your shares in 1 year's time and convert your pounds into dollars at the future spot exchange rate, which happens to be 0.58 pounds per dollar in this problem. So the first question says, what's the maturity value of the investment in pounds? Well, since you bought 1,000 shares and now stock price went up, which is good for you, and stock is now, each share is worth £65, which means your British equity investment is worth $65,000. So what is then your pound rate of return on this investment? Well, it's 30%, which is fantastic because you invested £50,000 into the stock, and then now your position is worth £65,000. So we simply computed percentage change between these two numbers, and then we got 30%. So your pound rate of return was great, positive 30% over a 1 year period. Then the next question is then, what's the maturity value of this investment in dollars? Well, now you have to convert your £65,000 into dollars at the spot exchange rate of 0.58, and this gives us $112,000. So our dollar rate of return is therefore 12%, 12.07%. So as you can see, it's lower than the pound rate of return. We still have a positive return, but it's not as high as your pound rate of return. So next question says, what's the change in exchange rate? Well, in order to compute change in exchange rate, please remember that we want to quote exchange rates in direct terms or in direct quote, or what we call in American terms. Since we're talking about what happened to pound happens to be our foreign currency here, we want to be doing that using dollar price of this foreign currency. So originally the exchange rate was 0.5 pounds per dollar, or in other words, it was $2 per pound. So originally exchange rate was $2 per pound, so 1 pound could buy $2, but then exchange rate changed such as it became 0.58 pounds to equivalent to $1, which really means if you take the reciprocal of this, what it means is that 1 pound now can buy 1.724 $1. So this exchange rate and this exchange rate are essentially the same. We just changed the way they are quoted. So as you can see, 1 pound buys now less dollars, so pound depreciated, and then that exact amount of depreciation is 13.79%. So this is why our dollar return is only 12% when our pound rate of return is 30%. So if you want to be exact and break down our dollar return of 0.1207% into the pound rate of return and change in exchange rate, we use this equation, and when we break it down, we do get the 12% dollar return. So in other words, your dollar rate of return on this foreign investment was 12.07%. It can be broken down into the local currency return of positive 30% and currency depreciation of 13.79%. When you put it together, you get a domestic currency rate of return of 12.07%. Now let's see what happens if you had agreed to sell 50,000 pounds at the forward rate of 0.55 pounds per dollar. So the first question, what's the maturity value of the investment in pounds? That doesn't change, right? Because the fact that the stock price went up to 65 pounds per share, that still stays the same. So the maturity value of the investment in pounds is still 65,000 pounds, and therefore the rate of return in pound terms is still 30%, so that's the same. But now what changes is that you are converting 50,000 pounds out of your 65,000 into dollars using the forward rate, because you had agreed to sell 50,000 pounds at the forward rate of 0.55. So you do this according to your contract, and that leaves you with 15,000 pounds that you need to convert into dollars at the future spot rate of 0.58. So when you put it together, your 65,000 pounds are converted into $116,000. So as you can see, it's a larger amount than the case without hedging. So this means your dollar rate of return is a little better. It's 16.77%. Yeah? So what that means is, I have a summary of these calculations here. What that means is, with hedging, obviously your local currency return stays the same, but your domestic currency return changes. With hedging, in this case, our return was 16.77%. Without hedging is 12.07%. So there are some differences between these two numbers, as you can see with hedging. The exchange rate movement is still obviously negative 13%. Pound still depreciated by negative 13% when you hedge, but it's really no longer applicable to us as much as before, because now we are converting most of our proceeds, our pound proceeds from the sale of the stock, into dollars at the forward rate, not the spot rate. So this is how exchange rate movements affects return from foreign investment, and depending on whether you hedge or not, the domestic currency return is going to be different.